It's a Tuesday morning. You wake up, check your phone, and the world has changed overnight. Oil, $103 a barrel, up 12% in a single session. The Strait of Hormuz, a narrow stretch of water you've probably never thought about, is now closed. Ships are burning in the Persian Gulf. And somewhere in a boardroom in New York, a trader just made $400 million before breakfast. Here's the question nobody on the news is asking. What actually happens next? Not to the markets, not to the traders. To you. Your grocery bill, your gas tank, your job, your future. Because when oil moves, everything moves. And right now, oil is moving faster than it has in a generation. To understand what's happening, you need to understand one thing. Oil is not just fuel. Oil is the blood of the global economy. Every product you buy, the plastic in your phone, the food in your fridge, the shirt on your back, at some point, oil touched it. In 1973, Arab nations cut off oil to the west. Gas lines stretched for miles. Inflation exploded. The stock market lost 45% of its value. A supply shock. That's what economists call it. What we're watching right now, it's a supply shock on steroids. Here's the scale of it. The Strait of Hormuz is just 21 miles wide at its narrowest point. But through that tiny corridor flows 20% of the world's oil supply, every single day. Saudi Arabia, Iraq, Kuwait, UAE, their oil exits through that strait. Iran just closed the door. Let's slow this down and explain exactly how this works. Think of the global oil market like a giant bathtub. The world consumes about 100 million barrels of oil every single day. Producers, Saudi Arabia, Russia, the US, are constantly filling that tub. Now imagine someone just blocked 20% of the pipes feeding into that tub. The water level starts dropping. Instantly, everyone who needs water starts bidding more to get what's left. That's what happened when oil crossed $100. Now, here's where it gets dangerous. Oil is priced in US dollars. Globally, everywhere. When oil goes up, the cost of making everything goes up. Factories pay more for energy. Trucks pay more for diesel. Ships pay more for fuel. Those costs get passed on to businesses, to stores, to you. Economists call this cost-push inflation. It's inflation that doesn't come from people spending too much money. It comes from the world suddenly costing more to run. And here's the cruel twist. The Federal Reserve's only tool to fight inflation is to raise interest rates. But raising interest rates to fight oil-driven inflation is like putting ice on a broken leg. It doesn't fix the problem. It just makes everything else hurt too. Higher rates mean higher mortgage payments. Higher rates mean businesses borrow less, and hire less. Higher rates mean your credit card debt costs you more every single month. So, the Fed is stuck. Fight the inflation and risk a recession. Leave it and watch prices spiral. This is the trap that oil shocks set. Every single time. Now let's talk about what's already happening, right now, in real time. WTI crude futures spiked nearly 12% in a single trading session. Iran's new supreme leader didn't just threaten to keep the strait closed, he threatened $200 oil. Let that number sink in, $200 a barrel. The last time oil came close to that was 2008, $147 a barrel, right before the global financial system collapsed. At $200 oil, jet fuel becomes so expensive that airlines start going bankrupt. At $200 oil, food prices, already strained, begin to surge because fertilizer, transportation, packaging, all of it runs on oil. At $200 oil, nations that import energy, Japan, India, most of Europe, face balance of payments crises. They're spending so much on oil imports that their currencies weaken. Their debt becomes harder to service. Dominoes start to fall. And here's what most people don't realize. This isn't just an energy story. This is a debt story. The world is sitting on $300 trillion in global debt. That debt was manageable when rates were low and growth was stable. An oil shock changes both of those variables simultaneously. Growth slows, inflation rises, rates climb. Suddenly, that $300 trillion debt becomes a live grenade. Let's look at who gets hurt first. Emerging markets, countries like Pakistan, Egypt, Sri Lanka, they borrow in dollars and buy oil in dollars. When oil spikes and the dollar strengthens, their debt payments explode. We've already seen this movie. Sri Lanka's economy collapsed in 2022. Egypt is on IMF life support. Pakistan nearly defaulted. An oil shock at this scale doesn't just hit drivers at the pump. It can trigger sovereign debt crises across 3 continents. So what does this mean for the next 6 to 12 months? Let's be specific. At the pump, if oil holds above $100, analysts project U.S. retail gas prices hitting $4.50 to $5 per gallon by summer. In Europe, where fuel is already taxed heavily, we could see $9 or $10 equivalent. At the grocery store, food inflation, already running hot, accelerates. Fertilizer, transport, refrigeration, all oil-dependent. Expect 8 to 12% food price increases within 2 quarters. In the stock market, energy stocks surge. Exxon, Chevron, Shell are already up 4% in a single day. But airlines, logistics, consumer stocks, they get crushed. The market doesn't go up or down cleanly, it fractures. For the Fed, rate cut hopes, already fading, are now essentially dead. Markets are now pricing no cuts until late 2027. Every startup hoping for cheaper credit, they're waiting even longer. For geopolitics, the U.S. has already mobilized a naval response. But a military escalation in the Persian Gulf risks pulling in Russia, China, and regional powers. This isn't just a market event anymore, it's a civilizational stress test. Here's the uncomfortable truth. We had all the warnings. The world's addiction to oil through a single geographic choke point. Economists have called it a systemic risk for decades. And yet, nothing changed. Because fixing it would require political courage, long-term thinking, and short-term sacrifice. 3 things that don't win elections. So we built a global economy on a foundation that can be disrupted by one man, in one country, closing one strait. And every time it happens, every 1973, every 1990, every 2008, we say we'll never let it happen again. And then we do. The lesson isn't that oil is dangerous. The lesson is that dependency is dangerous. Dependency on one energy source, on one supply route, on one geopolitical assumption that the world will stay stable. It never does. The question isn't whether the next shock is coming. It's whether you'll be ready when it does. If oil hits $200, what breaks first? The airlines? The banks? Or entire governments? Drop your answer in the comments, and let's see who saw this coming.